everybody, welcome back to Layman Loans. In this video, we're going to see how to take loan against securities. So first of all, what is a security and how much you can take a loan against security? Securities are nothing but shares and mutual funds. So if you have units of shares of any company or mutual funds, you can pledge those shares and mutual funds and get a loan. So to what extent you can get? Maybe maximum 50 to 60% of the total value of the shares or mutual funds is what you can get. Why you can get only so much loan? Because it's a high risk loan. So it is a secured loan, but with a high risk. Assume you have a share of a company currently trading at around 150 rupees and you have say 100 units of that share. Then the total value of your stock is about 15,000 rupees. Tomorrow, if the share value drops to 75, your overall worth of those 100 units will become 7,500. So banks are always very skeptical about giving loans against properties, and not many banks or NBFCs, that is non-banking financial companies, are interested to give loans against securities. But there are several institutions which does this as well. There is no doubt that stocks and mutual funds are one of the safest and great investments for every individual. But it is all about long-term investment. So we have a channel called Layman Investment. We have spoken in detail about how you can purchase mutual funds, shares, and several other forms of investment as well. But when you are in need of funds, at a timely instance, how you can monetize your assets on a short-term level through loans is what we are looking here. So loan against security is given by companies like Bajaj Finserv and several other companies. So what are the different types of securities? One, we have already seen the stock securities, that is the shares given by the companies that can be considered as a security. Second is a mutual fund or a ULIP insurance policy. What is a ULIP? It's called Units Linked Insurance Policy. So when you pay for a ULIP insurance, you will actually be allocated specific units of the mutual fund of your choice, or in the case you have given an automatic allocation system, then they will automatically allocate specific units for the amount you have paid. So what happens is you get a fixed amount of mutual funds allocated against the amount what you have paid as the premium. So that's a ULIP policy. And in the case of mutual fund, you are allocated a specific unit of fund for the amount you have paid. What is the primary difference between stock and mutual fund? Basically, a stock is that you are investing your funds on a single company. So the volatility is pretty high. So assume the stock drops tomorrow, the complete stock value will come down. In the case of a mutual fund, it is nothing but a group of stocks. So there is a fund manager who takes money from multiple individual retail investors and foreign investors. And with that fund, he will invest on multiple stocks in, like it can be a debt fund wherein they'll be investing on bonds, and it can also be a kind of a dynamic fund where they'll be investing on mid-cap companies and even large-cap companies. So based on the segment of companies the mutual fund manager wants to invest, he will invest, and you get the overall performance of the mutual fund on a metric called as NAV, that is net asset value. So assume you get a mutual fund for an NAV of 30 rupees and you get about 1,000 units. You have invested about 30,000 rupees. So currently you are holding the mutual fund worth 30,000 rupees. So if you are looking for a loan against security against this entire lot, you might be possibly getting 50 to 60% of the value as loan. And the beautiful part of loan against security is what they'll do. Assume you're trying to get a loan against property on a ULIP wherein you have, say, about 30,000 rupees worth of ULIP units, that is mutual fund units available. They'll give you a loan. Maybe after 3 years, you can apply for a loan. So typically, all these ULIP policies are like minimum 10 years, maximum 20 years tenure. And you are eligible to get your loan only after 3 years. And you can possibly, like, there are insurance companies which allow you to get it even after 2 years, and you can pre-close the policy only after a minimum period of say 5 years. Of course, there are few exceptions wherein they allow you to close or surrender the policy even after 3 years, but typically it's about 5 years. So assume you've been paying per year about 30,000 rupees, and in 3 years you have paid about 90,000 rupees, and end of 3 years you go to NBFC or a bank which provides this loan against security, that you want a loan against this particular ULIP policy wherein you have the total investment of 90,000. Currently, whatever is the value, so it keeps fluctuating based on the market trends. So assume the NAV is say 35 rupees. So 35 rupees into the number of units allocated. Assume in 3 years, about 300 units have been allocated. So typically it will be around 1,05,000 rupees is the total value of what you've invested. So in that, they'll give you 50% of the value. So assume about 1,05,000 is about 50,000 to 52,500 rupees is what you will be getting as a loan, and you have the option to clear off the loan if you surrender it after 5 years. So for example, you are saying after 5 years you want to just pre-close this entire policy and your overall surrender value. So assume, provided you have been paying on the 4th year and 5th year, it would have increased. But if you have even not paid for all these policies, then what happens is you have taken the loan when it was 1,05,000. You already got 52,500. You will be getting at an interest rate of around say 14 to 17% or so. And this interest payment or the EMI also you need not be paying. So what you can do is for a period of say 2 years you've taken the loan, 2 years interest payment, whatever is on the loan, will be deducted from the overall value, which is the entire lot size is 1,05,000, right? So they have already lended you 52,500, and remaining 52,500 rupees worth of units is very much there with them. In fact, the entire set of units is hypothecated to them. So what happens is, at the end of 5 years, assume the current value of the entire lot is 1,10,000, and they have already given you 52,500, and say 7,500 rupees was the total interest due for 2 years. So 60,000 they will mean 52,500 plus 7,500. 60,000 rupees is considered to be like the entire payment due for the loan. So 52,500 is already deducted from the lot. 7,500 they will again deduct. So out of 1,10,000, you will be credited 50,000 rupees of the balance amount. So you will not be paying EMI. You will actually pay from the stock value, the overall unit value only. So it is extremely sensible and very, very useful for people to pledge their securities and get a loan. And there are options wherein you start paying on a monthly EMI basis as well. But ideally, this model of wherein you hypothecate your securities, and because anyway your investment on a stock or mutual fund is static. So as long as you are not a day trader or an options trader, mostly people try to invest on all these on a long-term basis. So instead of just having your stock or mutual fund idle, you can put it at work and take a loan against that, and you need not even pay an EMI on that. So after a point of time, post maturity or when you surrender, it will automatically adjust for the interest and you will get the remaining value. This is one of the things which I wish to tell to all the subscribers. Do invest on mutual funds and do invest on stocks, and you can definitely monetize them even without selling them. And in case you want to close this entire loan, assume you got a lump sum and you want to take back all your units, you can close the loan by paying the principal along with the interest, and you can take back your stocks and mutual funds as well. Please do check out the link which we have given in the comments as well as the description. We'll be more than happy to get you. Thank you so much for connecting with us in this video. Looking forward to connect with you all in the next one.